Assalamu alaikum everyone, welcome back to another video. I hope you're having a wonderful day. From machine learning and large language models to smart applications and digital assistant, AI is a game-changing tool and will change how we do things moving forward. AI is not just a buzzword that's going to disappear overnight. There are so many benefits for us as humans. There are benefits for companies and their productivity and so on. And what I would like to do today is share with you guys 5 companies that are in that basically trend right now. So a lot of these companies have gone up so much, but I found companies that are still profitable businesses, okay, but they basically making use of the generative AI side of things. Now, what is the prediction for AI in the next 5 to 10 years? And that's something that is really important to us. We're not just focusing on what is happening right now. Can we make money from this in the long run? And that's what we want to talk about today. But before we do that, please like the videos. It takes a lot of time to put these videos together. Subscribe to the channel. Let me know if you have any questions. Join us on the Patreon. It genuinely helps the channel, okay? For $4.50 a month, you can get access to all the buys, all the sells, the Discord and so on. So please join us if you can, okay, inshallah. Right, let's talk about this. So this is a report written by Bloomberg. It says generative AI to become 1.3 trillion market by 2032. Okay, they talk about all sorts of things, basically how the impact it's going to have. And I want to talk about this. Okay, I'll come back to this in a second. So that's the 1.3 trillion. So by 2032. So the blue line here, the blues are the revenue side of it, and generative AI as a percentage of the total technology spend. So as you can see, a lot of companies basically are spending on AI. So as the technology spend, so they might have networking, they might have other things, but they are investing a lot on basically, and the investment side of it is growing. The market basically is actually responding really well to this whole AI situation because no company wants to be left behind. And this is some of the things. I'll share this report on the comment section if you're interested. But this is, for me, this is the most important part. Okay, if you look at here, okay, so this is a Bloomberg Intelligent interactive calculator, and what is done is it broke down basically what the companies basically need. So from hardware to software to generative AI based on gaming spending, based on the ad side of it, based on IT services, based on business services. And this is really interesting. So AI is not just touching one sector or one section, it touches everything. Hardware side of it, we're looking at right now $37.9 billion. In 2027, $223 billion, and in 2032, $641 billion in terms of market cap, in terms of this expenditure. Okay, and 33%, that's the compound annual growth rate basically of 33%. That's absolutely huge. Then same thing happens for IT, basically for servers. Servers need to be smart. Okay, so this is why companies like the Supermicro computers basically are actually now going to the moon. Companies like Nvidia in terms of storage side of things, GPUs and all of that stuff. Okay, so the hardware side of things is actually going well. So computer vision AI products and the conversational AI products as well. So you can pause the video and have a look at it, but AI is going to touch every single thing we do moving forward. And what we need to do really genuinely, like I said at the beginning, find really good companies that are going to be around for a long time, because everybody's talking about this. Now, another report that basically by 2030, they were predicting the revenue from this will be about the market size basically will be $1.8 trillion. $1.8 trillion, which is absolutely huge. So what I would like to do is share with you guys 5 companies that I genuinely think have a direct or indirect basically the revenue is basically affected by this whole AI situation, and some of them are game changers, some of them are starting to. Okay, so again, please don't take this as an advice and go buy these companies. Always do your research. This is my opinion, this is what I think, this is based on the research that I have done. Now this Arista Networks is the first company that we're looking at. This one is very similar to Supermicro Networks, is that side of. So if I can show you very quickly some of the things the company do. Okay, so sales data, client to cloud networking solutions for data centers. So for the, if you know, data centers is now basically one of the places where the AI is used a lot. So this company is now trying to basically diversify and make sure that they include some sort of AI in their products. So including new artificial intelligence, Ethernet switching platforms, campus wireless, and so on. So everything they do, and basically they add in some sort of AI into it. Now the company is very expensive right now, I must add that. Okay, and I'll show you exactly what Seeking Alpha is saying. But it has a wide economic mode and is only $81 billion market cap right now. Price is $261 per share. EPS right now, again, all these companies that I'm going to talk about today have a positive EPS. And the reason that this is important to me is because I'm not going to buy some speculative company that has nothing, no basically market cap yet, not market cap, market share, and they're starting basically new AI thing. This is not, you know, one of those companies. Some of these companies have been around for quite some time. P is about 40 right now. Forward P is only almost about 17. PEG ratio, normally we're looking for just below 1. Just up to 2, between 1 and 2 is okay-ish, but above 2 is slightly getting into the expensive. So as you can see, it seems very expensive right now. Profit margin 35%, return on equity of 34%, return on invested capital of 33%, 32%. So in terms of profitability, this company is absolutely in bright place. Current ratio, we're looking at about 4, which means basically we need more than 1 for the company to be able to cover their current liabilities for the next 12 months. Free cash flow, $2 billion. Again, I love companies with free cash flow. Now, the company has retained about 32% in the last 5 years. So it's only the last 5 years they've returned, because it's kind of newish company. Growth estimate for the next 5 years. Next year, we're looking about 15%. Next 5 years, about 19%. Like I said at the beginning, 34% premium right now. $195 per share is where they think the price should be. Now, if we see a correction in the next, I don't know, 12 months, whatever, and the correction means the market, you know, the S&P 500 going down at maybe about up to 20%. If that happens, this is definitely one of the companies that I'll be looking at. So I wouldn't touch it right now. It seems very expensive. But if the markets crash, or maybe we see some sort of a correction, is worth looking at this company. But right now, we'll leave it alone. Next one is Tesla. Everyone knows Tesla's been using AI for basically driverless cars and whatever they have, and the fact that they've now got robots and so on. So this company has been using AI for quite some time, and of course they will continue to use it for the next couple of, you know, I don't know, decades to come. So right now it has a market cap of $637 billion, narrow economic mode, about $200 per share right now. EPS right now $4.30. Forward current PE was like 46, forward PE about 20, which seems is actually becoming cheaper moving forward. Price to PEG ratio right now just above 2, profit margin 15%, return on equity 27%, return on invested capital again really good in terms of profitability, 12% there. Current ratio above 1, free cash flow $4 billion. Total return the last 10 years we're looking at 31%, which is absolutely huge. Growth estimate next year 36%, then 8% after that. Fairly valued right now, $200 per share according to Morningstar. Right now is exactly where it is. So basically this company seems very, very interesting right now. The next one that we're looking at is Salesforce, another company that has, I think they got a product called Einstein AI. So it's interesting to see. Again, this company is works with a lot of the companies out there, whether small businesses or larger businesses, in terms of cloud side of things, in terms of managing their business customer side of things. Okay, so analyzing data they collected from their customers, and then of course sharing that with the company, so the company can actually enhance basically how the relationship between the customer and as well as of course the business side of things. They've got so much, and they have been investing heavily into AI, as well as basically buying other companies, so smaller companies, and embedding them into their as part of their basically business, which is quite great to see. So right now they have a market cap of $280 billion. So they're not really a small company. They have a wide economic moat, $289 per share right now, EPS of $2.63. Forward current P is about 109, but forward P at only 19. price target in terms of price. Apologies guys, because I've just realized, I was thinking, why is this not aligning with this? So right now, okay, these are the forward PEs. The forward PE, this basically formula was extracting the wrong information. So 35 for Arista Networks, 62 for Tesla. So moving forward, it seems even more expensive, hence why probably the company has been going down quite a lot recently. And when it comes to Salesforce, we're looking about 35 right now, in comparison to where it is right now, which is 109. PEG ratio just below 1.5, which is actually not bad at all. Profit margin 7%, return on equity 4%, return on invested capital about 8%. Current ratio is above 1, $8.8 billion of free cash flow, 17% in the last 5 years total return wise. Growth estimate 17% next year, and then 25% every year after that. Fairly value right now $267 per share is where they think the price should be, which is quite interesting, because right now we're about 289. Again, is another company that could potentially benefit from if we have some sort of a correction. And looking at Seeking Alpha, as you can see, Quant is actually saying it's a strong buy right now. Wall Street is saying is a buy. Seeking Alpha is saying is a buy. So if we click Wall Street, you will see their price target is just where it is right now. Okay, and the earnings expectations for this company, I'll show you the rest of them in a second. It's about in the 50s for next year, 16%, 17%, 7%, and then from there 10% in terms of revenue side of things. So really great company, seems fairly valued at the moment. Next one that we're looking at today is Intuitive Surgical. This is one of the companies I don't think I've ever actually talked about. This, it has a market cap of $133 billion. This company uses, in fact, I was just reading on their website, basically in terms of surgery wise, they are using a lot of robots and so on. And it talks about here the future, it says we see the future of care that's increasingly technology enabled and digital informed. We believe there is a tremendous potential to harness current and future innovation in robotics, artificial intelligence, and so on, and machine learning. So they talk about these things in their one of the basically reports that they've actually done recently. So it's quite interesting to see how even these type of companies is actually using the AI and have been using the AI. So it has a wide economic mode. Price right now $378 per share. EPS right now is $5. PE right now we're looking at again, let me check if this is correct. Well, let's just go back here and we go this one. Let's click here. There you go, 60. So it's not correct. So forward period of 60, PEG ratio above, just seems very expensive. Okay, above 5. Profit margin right now 25%. Return on equity 14-15%. Return on invested capital about 13%. Again, profitability side of things absolutely fine. Current ratio 4.7. Free cash flow just below $1 billion. Again, this company has basically 133 billion market cap, but right now less than $1 billion of free cash flow. Again, I would love to see the revenue, so in fact I'm going to check that in a second. Let's go back in here. What are we looking at? This one here, because what I want to see is how much into the revenue side of things. Okay, $7 billion of revenue. Okay, so about they keep in about less than $1 billion, so they're not bad. 23 in terms of total return the last 10 years. Growth estimate next year we'll look about 17%. Growth estimate for the next 5 years we're looking about 12%. 65% in terms of premium right now, according to Morningstar. 207, 230 is where they think the price should be right now, is way higher than that. So if we look at the ratings for this company from Wall Street, Wall Street always says everything is a buy. But yeah, so 400. Okay, so Wall Street is saying is a buy, but this is why I love Morningstar, because they give you that margin of safety, and the company seems very expensive right now. Look at the PEG ratio for basically growth companies. You always use PEG ratio. Don't worry too much about the PE side of things. PEG ratio is really important. This is what Peter Lynch basically used to use. Right, final company we're looking at is Adobe. 247 billion market cap, has a wide economic mode, 565 billion. $65 per share. This company has you start using AI called Firefly, which is basically you can actually type comments on certain images and it will just change it completely. I think They definitely, I was one of the it was one of the companies I was worried about when AI started to come out, but of course the fact that they've actually started doing that now, I'm no longer worried about it. The company is absolutely amazing. They've got amazing product. If they can embed, just like Microsoft, some AI into their products, I think this company will be absolutely wonderful to have in your portfolio. P right now 46, forward P, this is correct by the way, 30. Let's go and check that's the correct one. I'm 100% sure that's correct. There we go, 30. Okay. PEG ratio of 2.25, so it doesn't seem too expensive right now. Profit margin of 28%, return on equity 35%, return on invested capital again 32%. Wonderful thing to see. Current ratio above 1, $7.3 billion of free cash flow right now, 23% in terms of increase in the last 10 years, total return, and the growth estimate next year 13, then 14% every year. So you're going to make 14%. There's going to basically it's going to grow 14% every single year in terms of earnings side of things. Morningstar saying value right now $610 per share is where they think the price should be. Now let's just quickly go over their earnings expectations, so you can see what's expected every single year. So 11%, 13%, 14%, 16%, and in terms of revenue side of it, again double digits, which is wonderful to see. Their ratings right now, according to Morningstar, the Seeking Alpha, it's about 18% upside from where we are. Let's now look at Salesforce in terms of earnings expectations. Again, 56, 16, 17, so on. Same double digits there. Ratings, as you can see, here's a strong buy, but Quant is actually strong buy, and the rest of it is just a buy. $290 per share is where we are now. This one here, earnings expectations, single digit, double digits for the next couple of years, double digits in terms of revenue side of things, which is really good. Wall Street is saying as a buy as usual, 10% upside from where we are, $288 per share. And finally, we've got Tesla as well. Earnings estimates 9%, almost 10%, 17%, 12, 15%. And in terms of ratings, Wall Street as usual 7%, 8%, $408 per share. Finally, Tesla, and earnings estimates now 2%, 37%, 22%. Again, this is probably why people don't want to buy this stock right now, and 14%, 50, 21%, and so on, which is quite nice to see. That's the 5 company I wanted to share with you guys today. So if you're interested in the AI side of things, every single one of these companies, some are, like I said, some are very expensive, some seem fairly valued right now. Don't take my word for it. Do your own research, find out a bit more information about the companies, and play it safe. No matter what happens, whatever you invest in, I'd rather invest in basically Adobe and Salesforce and the Teslas and whatever, okay, the Aristas, than actually any new shiny company that says we've got everything to do with AI, okay? Because these companies have other products, and they're going to embed AI in their products, which basically I feel more confident than actually a company coming out and saying everything we do is just AI. Okay, finally, the Sharia compliance side of things in terms of the Zoya, as you can see right now, there are no issues with any of these companies. Normally, high growth companies don't have that much of these things. Anyway, there you have it. Have a wonderful day. Assalamu alaikum. If you like this type of content, please, of course, please make sure you join us here. And as always, if you are interested in joining Trading 212, they are giving away free shares. So if you're interested, have a look at that as well. Have a wonderful day. Assalamu alaikum.